Today, I thought we'd spend more time with home prices around the country. How much will home prices climb over the next year? All year, the strength of the home buyer demand and the tight supply of homes for sale means that pretty rapidly the market found a floor on the home price correction of 2022. Even as mortgage rates rose and affordability pushed out of reach for many potential home buyers, there are sufficient buyers who can afford at these prices and these rates that home prices didn't have to fall. The number of buyers was surprising. Of course, if you were looking at the market in last fall, you'd have expected home prices to continue to fall further in 2023. That's what I was expecting. But the price correction stopped right after December. Last year in July, we talked about how it looked like home prices would be flat at best over the next year. After mortgage rates had spiked, though, in September, we got significantly more bearish on home prices for 2023. That bearishness from late last year reversed, demand picked up this year, and home prices stabilized. So the question now is, what do we know about home prices for next year? I saw Zillow released a report that it said they expect 6% home price gains over the next year. If you haven't been paying close attention to the data, that might seem shocking. So today we will look at the current price trends and the leading indicators to see if we can make some sense of where that comes from and what we can already see for 2024. The bottom line on home prices for the next 12 months, the leading indicators point to home prices that are flat to slightly positive in that time. If mortgage rates decline to, say, the 5% range in the fives next spring, I'd expect home prices to gain maybe 5%. If mortgage rates stay the same, it seems hard for home prices to climb much from here. If mortgage rates get more expensive, for example, 7 or 8%, then there is definitely downside risk for home prices. At Altos Research, we do not forecast mortgage rates, but the forecasters we respect still seem to agree that rates have probably peaked and will be declining. So that implies maybe the higher end of our range is likely. Altos Research tracks every home for sale in the country every week. We analyze all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. There's a ton of signal in the data that isn't the lagging indicators of sales that happened last month, those price headlines. So we're looking at that data in the active market right now. I'm Mike Simonsen. I'm the founder of Altos Research. Let's look at the data at the end of July 2023. Home prices now are essentially unchanged from last year at this time. It turns out that's exactly what we estimated last year in July. They'd be flat at best by this summer. That was coming off of 2 previous years of like 12 or 15% annual price gains. So that was a dramatic slowdown. The path, though, from last year to this year had a bigger crash and a faster recovery than I foresaw. So, perhaps part of the prediction being right was pure luck, but I'll call it a good call nonetheless. Nonetheless, the median price of single-family homes in the U.S. is $450,000 right now. This is the median ask price. And it's exactly flat from a year ago. It's unchanged from the last few weeks also. We like the median list price as a measure of the market better than the traditional view of median sales price, because these are the homes you actually have to choose from if you walk into the market right now. So if you're shopping today, the median home price in the U.S. is $450K. The median price of the new listings this week is $399,900. That's also the same $400K as levels last year this time. As the summer progresses later, each subsequent week of new listings gets priced at a slight discount to the previous weeks. And we will see in late summer if this discount stays in line with last year. Last year, late summer, was when we had big mortgage rate spikes, so a steeper decline in buyer demand and quick discounts for the homes that were on the market. So in the light red line here, you can see how the seasonal discounting was definitely accelerating in the second half of 2022. I think we'll end this year with this leading indicator flat to positive for 2022, meaning we're set up for mild home price appreciation in 2023. Of our forecast, home prices flat last year. Now the annual comparison gets easier. By this time next year, home prices will be flat to slightly up over 2023. The next step in investigating the leading indicators of home prices is to look at the pendings. The median price of the homes in contract now is $385,000. That's unchanged from last year, flat from last year, unchanged from last week, and almost 3% higher than a year ago. It is interesting that this $385,000 this week is the high point of home prices for the year, the pending homes for the sales for the year. Home prices overall peaked in June of last year, so at just under $389,000, and we did not re-reach that peak this year. So maybe 2024 is when we would pass that all-time home price peak again. Our monthly webinar where we dive into all the deep details on home prices, where they're heading, the available inventory of homes for sale, the local markets. That webinar is Thursday, August 17th at 10 a.m. Pacific. We'll spend more time with the inventory, the pendings there too. There's a link in the description below to register and join us. There are almost 1,000 people already registered for that webinar. If you're watching this video and you find yourself asking for more details on what this market is doing, where it's heading, then that webinar is where we spend a whole hour investigating. Click that link to join us. That's Thursday, August 17 at 10 a.m. Pacific. When we look at the total pace of sales, we can see that we're running about 10% fewer than last year. We started 2023 with 30% fewer homes in contract than the previous year. There are now 376,000 single-family homes in contract. Last year it was 418,000. You can see the gap from the last year has been narrowing. The dark red line most of the year has been approaching the light red curve of last year's pace. This pace of sales recovery got derailed a little bit in June when mortgage rates jumped from 6-ish to 7-ish. With the continued strong economy, the mortgage rates have stayed elevated. And we can see a slight slowdown in this year's recovery when rates are at 7%. Home sales slowed down dramatically in September of last year, but we'll see if this year our pace holds. Maybe in Q4, we will have more homes in contract than we ended 2022 in the fourth quarter. So we could have home price gains year over year and home sales gains year over year in the fourth quarter. When you look at just the new sales each week, you can see how the pace of the market has recovered. The count of new contracts this week is just over 68,000 single-family homes. That's still low, but caught up with last year when it was falling. See the last few weeks, the sales rate has been tracking just about the same as the year prior. Both weeks about 70,000 single-family homes going into contract each week. This is there has been significantly fewer home sales all year long. So 68,000 this week, while last year at this time was 67,000 new pending. So slightly more right now this week last year than this week last year. Early 2022, sales were still coming off that crazy pandemic demand. So the demand shifted really in July last year. And so the new sales volume each week, the comparisons get easier. And maybe we're at the transition point where the sales rate starts to overtake the prior year. This trend is why I've called it a soft landing for the housing market. Prices are flat year over year, not declining. Sales rate is not falling anymore and maybe starting to increase. As a result, inventory build is slow on a normal seasonal cycle. There are 485,000 single-family homes on the market now around the country. That's up 1% from last week. It is 10% fewer than last year this time. Inventory growth seems to have a few more weeks to go. Probably peak at the end of August like it did in 2021. Many years, the last week of July is the peak of inventory. But the data hasn't shown a plateau yet, so I expect a few more weeks of inventory growth. There are 50% fewer homes on the market now than in 2019 pre-pandemic. 50% fewer. When you want to look at home prices in the future, it can be helpful to look at inventory levels now. Specifically, looking at the year-over-year change in inventory to project home price changes another year in the future. So when inventory falls from last year, that means demand is greater than supply. Inventory is falling. And therefore, there is sufficient demand to push prices higher. Conversely, when inventory is up year over year, that implies demand is less than supply and prices will likely decline another year out. So during the great financial crisis, inventory rose 07, 08, 09, 10, and home prices declined subsequently. But since then, demand reversed. We are buying more homes in the decade since then, more homes than available supply, and inventory declined in most years in the past decade. Mortgage rates rose in 2018. That tempered demand. And by 2019, there were more available inventory of unsold single-family homes. By early 2020, therefore, prices were flat from the year earlier. So it took the incredible shocks of the pandemic to turn 2020 into such a roaring year of home price growth. But that didn't really start until May of 2020. Last year, it became clear that inventory was growing dramatically. We could see from that demand that buyers, that buyer demand slowing in a bunch of metrics across the real estate. And that's why we were able to foresee that this year's home prices would be down, which they have been until right now. So to recap, inventory is now 10% lower than a year ago. 10% fewer homes on the market than a year ago. That tells us that housing has more demand from buyers than supply from sellers. That helps us see that home prices will have slight upward pressure over the next year. Inventory is a leading indicator of prices for the next 12 months, but price reductions is a more immediate indicator for home prices. When the supply of homes for sale rises and demand does not, then the homes on the market have to take a price cut. So there are always homes on the market with price reductions. As a rule of thumb, it's about a third take a price cut before they sell. When the market's hot, fewer than a third need to cut price. When the market is cools, more than a third start cutting their price to find the demand. Right now, 34% of the single-family homes on the market have taken a price cut. That price cuts climb late summer, so this rate is perfectly seasonal. And so you can see the dark red line here in line with many other recent years. And last year, the light red line was rising quickly. Price cuts happening. That indicated home price declines to start 2023, which is exactly what we saw. The takeaway with price reductions as a leading indicator is that we can see plenty of demand to keep a floor on prices. Sellers are in a much better shape now than they were last year. This means that the homes on the market now are priced well, they have buyers, and therefore we already know that sales that will complete in August and September have price support. Home prices are not falling, even though mortgage rates are pretty high. There are plenty of buyers who apparently can afford to buy, more than there are sellers anyway. So 34% price reductions is not low. Right, it's not a hot market, so demand is obviously way down from the pandemic frenzy. So there's nothing in the data that says home prices are surging from here. There's nothing in the data yet that makes me particularly bullish on home prices. So the real estate market is much more balanced than it has been in many recent years. So when you see a firm forecast, for example, that home prices will climb 6% in the next year, I would presume that forecast includes assumptions that we avoid recession and that mortgage rates slide down from 7% to maybe below 6%. So when mortgage rates fall, that spurs demand, but not supply. And so inventory falls, buyers emerge, and home prices therefore rise. At Altos, we don't forecast recessions or mortgage rates. So when we talk about our price expectations we in the coming year, we're looking at the very direct data that's in the bag already right now, the stuff we report here. That's why we track every home for sale in the country. There is so much more signal in the active market that looking at the lagging sales data simply can't tell you. If you need to help buyers and sellers understand the housing market, help them make decisions, go to altosresearch.com and book a free consult with our team. We'll help you know how to talk about the housing market with your clients and your prospects today. There's a link in the description below to get that free consultation. There's also a link for the webinar. Don't forget to click that and join us Thursday, August 17th. All right, thanks, everybody.